Markets started the week on a positive note as falling oil prices eased inflation fears, pushed bond yields lower, and lifted equities on expectation that the war in Iran will soon come to an end. Yet the good news comes at a time the central banks start reacting to rising inflation by raising the interest rates, meaning that a part of that optimism could be jinxed by higher borrowing costs. Still, if the war in Iran really ends and energy prices ease durably, a rotation from highly valued technology to cheaper non-technology peers will be the only healthy move to keep this market somewhere closer to healthy. So welcome to Swissquote's Daily Market Talk. It's Tuesday, June 16th. I'm İpek Özkardeşkaya, and we will talk about what's healthy and what is not. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the week started on a positive note, obviously, as oil prices fell to levels last seen in the first weeks of the Iranian war, sending global yields lower as well and equities higher. The European Stoxx 600 index, for example, advanced to a fresh all-time high level yesterday on the back of the optimism that the end of the war would narrow the gap between the technology-heavy indices that amassed huge capital inflows since the early days of the Iranian war and industries that were more exposed to higher energy prices that actually did not do well. But at the end of the day, the Stoxx 600, which is mostly cyclical, paired gains and closed just 0.19% higher, while the major technology-heavy US indices outperformed with a 1.65% rise in the S&P 500 and a 3% rally in Nasdaq 100. SpaceX, on the other hand, rallied another 20%, ladies and gentlemen, even more in the after-hours trading, pushing the company's valuation to $2.5 trillion US dollars. That is just a touch below Amazon's. The only difference is that SpaceX is burning cash today as the revenue from Starlink and other businesses has been unable to counter the heavy space exploration spending, whereas Amazon made more than $700 billion US dollars in revenue last year. So yes, it looks like a speculative bubble. This valuation makes absolutely no sense. People are buying SpaceX today in expectation that others will be buying too, and the latter will push the price higher, and that's, well, the definition of speculation. But one day, someone will say, hey, the emperor is naked, and on that day, the company's fundamentals won't be there to stop the sell-off, unfortunately. So make sure you set your stop loss and stick to your risk management strategy if you are trading and when you are trading this stock, which promises to be extremely volatile, hence fun, but also very much risky. But there's a bigger problem, and that's the fact that meme stocks have been around for years and they have amassed retail investors' attention, sending companies like GameStop and AMC, for example, to incredibly high levels just because people wanted to do so. Just because people felt that they could send the share prices as high as they wanted to, they just pushed the limits to see how high could these companies go. But the fundamentals, of course, caught up. GameStop is down today by more than 80% compared to its January 2021 top, and AMC is down by more than 99% because the movie theaters are empty today, almost empty, and it was foreseeable when the stock traded nearly $400 US dollars per share back in May 2021. Today is worth around $2 a share, and I believe that that valuation makes more sense than $400 per share given the growth potential of the movie theater business. Now, obviously, I don't expect SpaceX to share a similar destiny than AMC or GameStop, as the company still got big potential to do whatever it dreams of doing in the space, like space data center and orbit stuff. And if not, well, the company still got Starlink, for example, and a few data centers from xAI that it could lend out to make decent revenue. I'm thinking of the nearly $1 billion US a month worth of computing power that it contracted with Google recently for 32 months. But at the end of the day, whoever is buying SpaceX stocks like there is no tomorrow will understand that the space exploration dreams will come at a cost, and SpaceX stockholders will be paying that cost. So back to the problem that I started to talk about. SpaceX will be included in major US indices like Nasdaq and Russell. And that worries me the most. A company with no fundamental support to justify such valuation will be bought by these indices and also the ETFs that track these indices, meaning that this meme stock will make part of everyone's portfolios and not a small portion of them. If included in the Nasdaq 100 today, SpaceX would make up to more than 6% of the index. So if you hold any of these indices, or ETFs tracking these indices, it is today very important to understand the ingredients of these indices and probably to diversify. Diversify toward indices that do have healthier, sure, more boring, but healthier ingredients. Remember, we simply need less sugar for a longer and a healthier life. Now, zooming out and looking at the global macro, if the war in Iran comes to an end, really, this time, bringing energy prices sustainably lower, the non-technology pockets of the market should eventually see some capital rotation as these companies have become relatively cheaper compared to the technology peers, especially during the Iranian war months, and a healthy and a durable rally in the market should be based on more than a single pillar. That means that at some point we should start seeing the technology appetite ease and money start flowing toward the non-technology pockets of the market. Otherwise, the narrowing market breadth today will be exposing the global financial markets to a potentially heavy sell-off if something happens in technology stocks. Now, looking at the geopolitical and macroeconomic setup, it looks like this could be a good time to rotate toward non-technology pockets of the market. But the main challenge today is that the central banks have just started to react to rising inflation at the same time the war potentially ended, meaning that the higher borrowing costs may jinx a part of the end of war optimism and lower energy costs. Because remember, the European Central Bank last week raised its interest rates for the very first time in almost 3 years to fight inflation, and the Bank of Japan today went ahead and raised its policy rate by 25 basis points to 1% as expected. The rest of the week is not expected to bring any more rate hikes from major central banks. The RBA didn't do anything today. It just kept its policy rates unchanged. The Fed, the Bank of England, and the Swiss National Bank are also expected to hold fire at this week's monetary policy meetings and could eventually get away without raising their interest rates if inflation comes lower as fast as it went higher. I also believe that the European Central Bank could eventually also walk back its latest decision to raise its interest rates. But for that to happen, again, inflation should prove to be temporary. When does inflation go from being temporary to being sticky? Well, it's when it spills from energy to other prices, and more importantly, when it shows up in salary negotiations. This is when workers ask for a higher pay to counter the loss of purchasing power due to higher prices. And when they obtain a pay rise, they can spend more, and the latter fuels inflation. That's called a wage price spiral. It is a nightmare of central banks. It's everything they want to avoid. So in the coming days and months, the wages growth will be closely watched by investors to understand how anchored the latest rise in inflation has become. Today, for example, the wages in the Eurozone will give an idea on how the wages were affected by the rising inflationary pressures. The thinking is, if the wages growth remains relatively soft, ideally close to inflation, inflationary pressures will be manageable, allowing a softer monetary policy stance in the coming months. But if not, expect more monetary policy tightening. In the FX markets, the US dollar index is stronger again this morning as investors have started questioning the risk of a peace deal not going through. The euro-dollar felt quite uncomfortable about the 116 mark yesterday, hinting that the pair needs more time and probably a few more answers to the peace deal questions to go above this level durably, while the Bank of Japan's rate hike today did nothing to ease the selling pressure in the Japanese yen, confirming how broadly investors were expecting today's hike from the Bank of Japan and how an FX intervention will be inevitable to clear the short-term bearish yen positions, which rose to a 9-year high according to Bloomberg. Again, investors demand more rate hikes from the Bank of Japan to leave the Japanese yen alone, but in the shorter run, a cleaning of the crowded bearish yen positions appears to be inevitable. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.